Okay, Michael, Neil, can I ask about FY21? I mean, the guidance was for a recent a loss of 800 to 850 million. You've beaten that, but nevertheless, it's still a loss of 815 million. You might just talk about it, please.
Yeah, look, I mean, the last year has been clearly the most challenging in our 35-year history in Ryanair. European government restrictions, the COVID restrictions to protect public health have collapsed our business over the last year, as it has every other airline. We've seen an 81% decline in traffic and an 81% decline in revenues. And while we had a very strong cost performance, costs were down 66%, it wasn't enough to offset the loss of revenues, which is why in the prior year we recorded a profit of just over $1 billion, and this fell to a loss of 815 million this year. Better than we had originally predicted, but nevertheless a fairly traumatic loss for an airline that's been consistently profitable for our 35-year history.
One area has consistently done well has been ancillary revenues, and again this year relatively. Maybe what's behind that?
Yeah, we did have a strong year, Stephen, about just €22 per passenger spend in ancillaries. Standouts for me would be the conversion on the reserve seating and the priority boarding. They performed very well, and that nicely offset a collapse in our onboard spend.
In just talking about ancillaries, where do you see this going, post-COVID? I mean, clearly there's investments in Ryanair Labs and things like that.
We expect it to recover strongly. I mean, the key products, which is priority boarding, reserve seating, has held up remarkably well during COVID off a low passenger base, but we see no reason why that will change. Ryanair Labs continues to roll out dynamic pricing models. We continue to evolve and improve the way our customers select and pay for ancillary products. And we think there's an element later on this year whereby the onboard spend will be helped by the reintroduction of duty-free on flights to and from the UK.
There's a lot of exceptional charges with Hedge in effect with this, Neil. Maybe we could talk about them.
Yeah, I mean, we did 200 million exceptional charge in the year. This was all down to, or most of it was down to the traffic declines. We had hedged our fuel on pre-COVID traffic volumes. So as a result, a good chunk of our fuel hedges went ineffective. And then, of course, we had ongoing delays in aircraft deliveries, and we renegotiated slight reductions that, again, made some of our CapEx hedges ineffective. But that's behind us now, and we're moving on.
In terms of just... Can I ask about the fuel hedging position and actually the policy around fuel hedging? It comes up quite often with investors. Also, if I ask about the layered in carbon cost in there and counteracted with fuel efficiency. So just generally about fuel, because obviously it's a huge cost item.
Well, I mean, the key issue, for the next 12 months, we're 50% hedged at about $54 per barrel. Current spot's about $68 a barrel. I mean, I think our hedging philosophy will change into the future. With the experience of COVID, I think we'll never hedge 90% of our rolling requirement again. We'll probably hedge between 50 to 70% on an ongoing basis. And we're also looking at the possibility of hedging some of the carbon, as you rightly point, the carbon exposures going forward. We have a surplus this year, so it's not an issue for us. But certainly into FY22 or FY23, FY23 or FY24, we'll look to start hedging those carbon tax exposures as well.
In terms of just COVID, obviously, and in terms of the preparing for the ramp up into the summer, it must be challenging with close-in bookings and just operationally.
Yeah, it has been very challenging, Stephen, but we've remained very flexible. We're matching our capacity against the demand that's in the market. We've launched a number of new bases for this year. We've 8 new bases for the summer and into the winter of FY22. And since the start of COVID, we've worked on keeping our crews, our aircraft current, which means that when we do get back flying, and there's huge pent-up demand out there, that we're ready to go at almost a moment's notice.
And in terms of the booking curve, it must be very close in. Michael.
It is. As travel restrictions are lifted, the booking curve is remarkably close in. I would say, though, over the last 6 weeks, particularly as the UK has lifted restrictions, we've seen a dramatic strike, if you like, spring back in bookings. The first week of April, for example, we took just over 500,000 bookings. Last week, we exceeded 1.5 million. So it's trebled in the space of 6 weeks. Now, clearly, it won't continue to grow at that rate, but it does show that there's a very strong pent-up demand for low-fare air travel, and I think we would hope to capitalise on that, particularly families booking summer holidays through the peak period.
I guess a question that often comes up is in terms of the fare levels and with the close booking curve. Maybe you could talk about that.
Yeah, well, as you said, Stephen, as Michael already pointed out, the booking curve is hugely close in, so it's impossible to say where the fares are going to end out on this year. Our objective will be to build the loads again. We're load active, yield passive. That strategy hasn't changed. A lot of good reasons for doing that. It helps the unit costs in the business. It helps recover traffic for the airports around Europe, and importantly, it helps us grow our market share. So look, I can't give any guidance on fares at this point in time.
But I think it's fair to say we'd expect volumes to recover first and then followed by pricing. And that would be very much the way we'd be running the business over the next 6 months.
Yeah. Well, I mean, if I can ask just related to that, the whole issue of PCR testing and the cost of that, clearly that may affect airfares. And maybe could you review, Michael, on a wider question on the EU green certs or even the UK traffic light system and how you think this kind of blockages play out?
I mean, I'm not sure. We don't believe a lot of it just gets overtaken by the rollout of the vaccinations. Like most EU countries expect to have about 80% of their adult population receive a first vaccine by the end of June. When you have widespread population vaccination, particularly in Europe, we see no reason for testing whether it's antigen or PCR. It adds nothing. But I think, we're cautious. I worry about government passports and things that are issued by government. But what we've created in Ryanair is you're able to upload to our mobile app either your vaccine certificate or your negative PCR document. But that needs to be something simple. It needs to be either paperwork that's uploaded or something, for example, the NHS app in the UK, which you're able to identify. And most of the European countries have already announced that they're willing to accept that for entry this year. So I think we don't have time and governments won't get their act together on a kind of a Europe-wide passport, but accepting verifiable vaccination confirmations or negative PCR testing would be fine for this summer.
Okay, maybe we just talk about growth plans and potential. And I mean, there's a number of new bases and what type of airports should be looking at.
Yeah, I mean, there's huge growth plans out there at the moment and huge opportunities, particularly as we take delivery of the MAX Game Changer aircraft over this summer and the next 4 or 5 years. We've already announced 8 bases, including the likes of Billund, Arlanda in Stockholm, Zadar, Zagreb, and many others. I think there's going to be huge opportunities, particularly with the capacity that's come out of the market. We've had a number of airline failures in the past few months. I think there'll be more. We've seen a lot of capacity come out, and we're the only airline that's actually growing with any significant numbers over the next few years. So we would have good confidence that we'll deliver on our target of the 200 million guests by FY26 as we move the aircraft around the various bases in Europe and grow new bases and opportunities.
Michael Neal, can you talk about the cost leadership of Ryanair and what the initiatives you've done over the last number of years to maintain and indeed enhance that as we go into the next couple of years?
Yeah, I think we've done very good work in the last 12 months on the cost base. I mean, the obvious ones, we've negotiated pay cuts, not just with the managers, but most of our employees across all bases. Between 5 to 20% pay cuts. They'll be restored through years 1 and 2 and then restored back to them in years 3, 4 and 5. We've repriced the Boeing Game Changer aircraft order, which will deliver further modest savings in aircraft costs for the next decade. We're seeing a significant uptick in airports out there, looking to recover traffic, putting in place growth incentives. I mean, the 3 key ones we point to are at 3 of our largest bases, which is Stansted, Bergamo in Milan, and Brussels, Charleroi. We've now extended low-cost deals at those airports out to 2028 or to 2030. So, you won't see a lot of these cost savings arriving in immediately, but the fact that we have extended and lengthened those kind of cost deals means we will retain a huge cost advantage over every other airline in Europe, I think, for the next decade. There are going to be some cost pressures. I mean, we think there's a real risk that the Eurocontrol ATC providers will be attempting to pass on their losses to the airlines as we recover coming out of COVID. Some of the monopoly airports are going to try to do likewise. And we've called for regulators around Europe to be wary of that. We've all suffered huge losses in the last 12 months, but the airlines can't be the insurer of last resort for monopoly providers of either air traffic control services or monopoly airports. Where the market functions efficiently, we're seeing lower costs, partners working with us to recover lost traffic and also to look forward for growth. As Neil said, we've announced 8 new bases in in this fiscal year, including some very exciting primary airports: Arlanda in Stockholm, Riga in Latvia, and Zagreb in Croatia.
Maybe you can talk about the Boeing, the MAX, the A200. I mean, it's the raison d'etre now going forward of the cost structure. What's the delivery profile? When is it coming?
It was supposed to come in January. Then it was licensed and approved by the EASA and the FAA on the 6th of April. And we're quite upset with Boeing that 8 weeks later we're still waiting for the first delivery. The management in Seattle have continuously missed promised deadlines for the first delivery. We're now being told by them that the first delivery will be in late May. I'm not sure we necessarily believe that. But originally we had hoped to take delivery of 14 of these aircraft in advance of summer 2021. But as the management team in Seattle continues to mismanage that process, I think there's a real risk now that we may not see any of these aircraft in advance of summer 2021. Over the medium term, we expect those delivery problems to be resolved, and we're confident that we'll take at least 60 of those aircraft in advance of summer 2022. So in the short term, there's nothing but problems, and the problems lie not with the FAA or with the EASA, but with Boeing. But over the medium term, we think this is a very exciting aircraft. We're looking forward to taking those deliveries. And we will be one of the few airlines in Europe with 60 new aircraft for summer 2022, able to restore traffic or deliver new growth to those airports that are willing to work with us to achieve that.
I mean, in talking about growth, where are those aircraft going to be based? Is there already planned?
Initially, Stephen, the first number of aircraft that come in, we put them into kind of key maintenance bases for the likes of Buzz, Malta Air, and Ryanair across Europe. And thereafter, the airlines are competing with each other to try and get capacity. They want to grow. They're all very keen to get their hands on these new efficient aircraft. So there'll be plenty of opportunities across Europe to place them.
And you have the pilots being trained on them with the simulators, maybe?
Yeah, we're one of the few airlines. We have 3 MAX simulators already in Dublin and Stansted. And so we're actually already putting pilots through the simulators. We already have them trained for the MAX aircraft. What we need now is the aircraft.
Yeah, okay. What about the Neil, the fleet plans in terms of leases you have or sales process?
Well, the key fleet plans we've just discussed is the delivery of the 210 game changers, and that now enables us to hand back the remaining Boeing 737 leases that we have. We've 2, for example, going back towards the back end of this month. We'll also be able to sell some of the older aircraft out of the fleet, which again had been slowed down due to the delay of the MAXes. So that'll help keep the average age young as we move forward. We've got 29 A320s in the fleet. That's pretty much frozen, and we start returning the first A320 from the winter of 2022. So over a kind of 3 to 4 year period, that fleet will wind down as well, and we'll be left with about 600 aircraft and 200 million passengers per annum at that stage, which would be roughly around FY26.
I mean, one thing comes up again is the MAX 10, which is the larger Boeing aircraft. That's still in the thought process down the road.
I mean, we've already confirmed that we're in discussions with Boeing on a follow-on MAX 10 order. Boeing have committed that we'll be first in the queue, but we're not there yet. The pricing isn't yet right. But I would be reasonably hopeful that once we get the game changer aircraft delivery issues resolved, we can then focus our energies and those of Boeing on negotiating what I hope would be a follow-on order for MAX 10s, which would take us out into deliveries in the period from 26 through to 2030.
I mean, maybe you could talk about the different airlines in terms of within the group, whether that's Buzz or Lauda or Malta Air.
Yeah, well, they're all performing well. Last year was a challenging year for them, but in fairness, they stepped up to the plate. They cut costs across all of the airlines. They preserved cash as we needed. And now, there's positivity. They're looking forward to delivery of the first aircraft coming in and starting to grow again. Buzz have just under 50 aircraft in their fleet and keen to add to that. We've 120 Boeings now in Malta Air, and Lauda, as we already discussed, have 29 A320s and would hope to get their hands on some Boeings in due course.
One question that comes up a lot, of course, is the balance sheet and liquidity and where that is going forward. Obviously, you have a triple B rated balance sheet, but obviously that's kind of a significant issue at the current time.
Yeah, sure. I mean, as you say, the balance sheet is straight away. We're triple B rated, airline industry leading, world industry leading rating. We at the end of the year had 3.15 billion in cash, which was a very creditable performance in a year when our traffic collapsed by over 80%. And I think it demonstrates the strength of our business model. Now, clearly net debt has jumped, and we'll be very focused in the next number of years about repairing the balance sheet, paying back net debt. But we continue to look to that balance sheet strength with 3.15 billion in cash, and 85% of the owned fleet is entirely unencumbered. Unlike a number of competitors, we haven't been out there doing sale and leasebacks at distressed prices. We haven't needed to, thankfully, and we will emerge out of this COVID-19 pandemic with one of the strongest airline balance sheets in the world.
The obvious question is in terms of cash burn, Neil, which, how has that been lowered during the year? And I guess we're all waiting for working capital to turn positive.
Yeah, well, we reacted very quickly at the start of the COVID crisis, and we cut costs right across all of the airlines within the group. That was important. We participated in the various furlough and government payroll support schemes again, which was hugely beneficial. The share buyback, as you'll remember, was cancelled last March, and we deferred non-essential capex. And then, of course, to strengthen the balance sheet, we went to our shareholders in September, where we raised 400 million. We did an 850 million bond, and we tapped the CCFF for 600 million sterling, which we've now extended out to 2022. And on I suppose the cash burn now at the moment, we're seeing the last couple of weeks, thanks to the improvement in bookings, that operational cash flow has gone marginally positive. So we'd be hopeful that as we go out over the course of the year, we will see some improvements there.
And in terms of capex going forward, I mean, obviously with the Boeing deal, maybe you can give some flavour, Michael, of where gross capex is at least.
Sure. I mean, obviously with these delivery delays, the number keeps moving backwards. But subject to taking 60 of those aircraft before summer 2022, we expect kind of gross capex in the second half of the current fiscal year of about 1.2, 1.3 billion euros, including maintenance capex. And then the capex will ramp up over the next 4 years. We should hit peak capex in FY23 or FY24 at between 2.3, 2.4 billion euros. We're confident that we can actually finance all of that through our own cash generation and debt instruments over that period.
In terms of financing the aircraft, Neil, is like the bond market the preferred route, would you say, given the balance, given the rating? Or I
suppose, as Michael just alluded to there, we'd expect to do some of it out of our own cash resources, but we do have an extremely strong balance sheet, triple B investment grade, 85% of the fleet unencumbered, which means we can be opportunistic in what we do. We're interested in the lowest cost of financing. I think it'll be a combination of cash resources, bonds, bank debt. It could be secured or unsecured, probably more likely unsecured. And indeed, none of the key lessors have exposure to us now on Boeings at this stage for sale and leaseback. So, we'll have lots of opportunities over the next few years to come up with the lowest cost of financing for the fleet.
Obviously, very topical is ESG. And, you got this CDP B- rating, but environmental, maybe you can go through that, and SAF. It's again, obviously very in front of people's minds at the moment, Neil.
Yeah, since we appointed a Director of Sustainability earlier on this year, we've made significant improvements. As you said, the CDP B- rating was something that we're very pleased with, but more to do on that front. We've set aggressive targets for ourselves where we want to reduce CO2 per passenger kilometre by 10% to 60 grams over the next decade. And, key to achieving that will be the game changer aircraft, which are starting to come into the fleet, 16% more fuel efficient and lower CO2. But we're also actively now looking at SAF, sustainable aviation fuels, and we've set a goal for ourselves to have about 12.5% of our fuel requirements dealt with through SAFs by 2030. To help get there and to make sure we've got the right blend, we've invested with Trinity College Dublin to set up a sustainable aviation research centre, which will look at this and hopefully make SAF more readily available. And of course, we're leading from the front with a lot of other initiatives as well. We're the launch partner with CNBC on their ESG panel, which includes 35 global leaders. We've been involved in the sustainable aviation research with Trinity, and we're doing a number of other things with Eurocontrol, the EU, and various other parties. So, I think we've made huge progress, but there's more to be done.
Can I just come back on SAF? SAF, the industry has been talking about it. It seems to be now the topic of focus. Do you think the industry is minded to get the cost and the availability of SAF, so it's a credible alternative, really?
We think so. I think there's a renewed impetus behind the development of SAF. The European Commission is pushing it very hard. The airlines are working very cooperatively together. The big challenge and the issue for us is, can we produce or can we source enough availability by 2030 to replace 12.5% of our own fuel? There's no doubt that's a challenging target, but the technology is advancing at pace. We think the cost of SAF will come down significantly. And so we've set that ambitious goal. Whether we'll get there or not, who knows? But if we don't start on this journey, we won't get there.
Yeah, and I think it's encouraging. A number of fuel companies have contacted us since we announced our target to see where they can help us to get there has been huge. So I think the industry wants to get there. We want to get there. So we just have to work on it now over the next decade.
And in terms of, just to talk about the unions, which are, and the working and engaging them through the crisis. Maybe how
I think it's been remarkable. If you look around Europe at the number of carriers that have gone bust, legacy airlines who have let go thousands of employees. We've managed this process over the last 12 months largely by negotiation with our people and their unions. We've put in place sensible pay cut arrangements or pay deals with our people, generally around pay cuts in years 1 and 2, but being restored back in years 3, 4, and 5. And they were all reasonably modest, between 5 and 20%. 5% at the lower paid, 20% for the higher paid people. Management have taken pay cuts in the last 12 months. Any bonus payments there's been no, but have been cancelled in the current year. So I think we've done it sensibly, working with unions and with our people. And the other thing that we've managed to do is to minimise job losses. We originally set out a target of between 3,000 and 5,000 job losses. I think it's less than 1,000 over the last 12 months. And I think the other thing I would point to is we have worked very hard to keep all of our pilots and cabin crew current during the last 12 months, even if in some cases that meant flying empty aircraft. We've managed to keep people from current so that they don't have to go back in and do very long simulator retraining or refresher courses. We're ready to go back into service as quickly as we can, as soon as the vaccine rollout allows us to return to service this summer.
When in thinking about the industry and more longer term, do you think when capacity or when post-COVID, the capacity in the market comes back, or there's a lot of retrenching? You see Alitalia and others. And I'm really thinking, the way the US market consolidated and whether the European market can at least accelerate that consolidation.
I think there's a lot of capacity simply can't come back. You've seen, if you take the airlines that have gone bust, the Thomas Cooks, Germanwings, Norwegian effectively, there are huge amounts of capacity that simply cannot return. Even within the state-aided carriers, you've seen Lufthansa significantly reduce the short-haul fleet. Alitalia has reduced the fleet by 25%. TAP has taken out 30 aircraft, nearly 20% of its fleet. Those planes can't come back. So I think we're looking at a medium-term environment in Europe, certainly for the next 3 or 4 years, where at best the available capacity will be at between 75 and 80% of its pre-COVID pre-COVID numbers. And I think that's why it's so key that we have, with Boeing, put together this this order of the 210 game-changer deliveries delivered over the next 4 or 5 years. It puts us in the box seat to begin to make up that capacity shortfall. But it will take 3 or 4 years at least before Europe returns to the pre-COVID capacity that was there. What do you think, Neil?
No, I'd agree totally with you, Michael. In fact, some of the other airlines that are growing are actually moving their capacity outside of Europe as well. We're seeing that with Wizz, for example, where they're going more into the Middle East and down towards Pakistan and India. So we'll be the only real airline growing with any numbers for the next few years, which is why I think we'll have no difficulty hitting the 200 million customers and having lots of choice in where we place the aircraft.
Neil, what's the risks of cost increases in the industry, say environmental taxes, for example?
Yeah, I think there's a number of risks out there. We already talked about, for example, we could see upward pressure on the Eurocontrol, but environmental taxes are something that are coming. But I think there's a desire within the EU and among the airline groups to invest more in sustainable aviation fuels, which might reduce the impact. There's a chance that they may be used as some form of state aid, as we've seen already in Schiphol, where short haul where long haul connecting traffic has been exempted. So there are real risks, but I think it's important, and that's why the airlines are working hard to reduce CO2 across the industry. But there is a real risk in the next few years. There'll be more APDs, there'll be more environmental taxes coming down the tracks.
And obviously, to the extent that there isn't environmental taxes, we would say to the European Commission, well, by all means, if you're going to levy environmental tax, can we please have back the 630 million in environmental taxes we already pay on an annual basis? UK APD, German APD, ETS scheme. Like, we can't have double and triple environmental taxes. And the other big issue, in that area is, at the moment, the environmental taxes are only levied on the intra-EU travel. The legacy airlines are not paying environmental taxes on their long-haul flights, nor are the non-EU airlines, despite the fact that long-haul travel is far more environmentally damaging than the short-haul efficient, low-cost, the short-haul efficient, low-fare carriers in Europe.
Yeah, there was a very good report out of Eurocontrol back in January, which proved that point, where it showed something like 5% of the traffic, the long haul, was causing 51% of the emissions. And as they design Corsia and move on, it's imperative that that's included within any scheme that's put in place.
Yeah, maybe just talk about the outlook, Michael.
Yeah, okay, look, there's huge uncertainty for the next 12 months, Stephen. And much of it revolves around how fast vaccine rollouts across Europe allow for removal of travel restrictions and recovery, particularly into the peak summer travel period. Q1 has been low. We're guiding somewhere between 5 and 6 million passengers in Q1, but there's been a very dramatic recovery in bookings in just the last 5 weeks. If that continues, and we think it will through into the remainder of June, July, then we think we're on track certainly to hit the lower end of our current guidance, which is full year traffic of between 80 to 120 million. And I think as long as there's no recurrence of outbreaks or variants that the vaccinations don't deal with, then I think we can look forward with some degree of optimism into that year. We at this point in time think we're somewhere between 80 to 100 million passengers. The likely outturn, subject to yields, obviously, is that we're looking at something between a very small loss and break even for the next 12 months. But there's a lot of moving parts and there's a lot of uncertainty. And most of the uncertainty revolves around the timing of the recovery and the fares that people will pay into the key kind of June, July, August, September travel period.
Okay, well, thanks, Neil. Thanks, Michael.
Thanks, Stephen.
Thanks, Stephen. Pleasure.